Good morning and welcome to the Killik & Co market update. Yesterday we had results out from the four, otherwise known as Apple, Amazon, Alphabet and Facebook. These four companies have actually been criticised for all releasing their results on the same day. The reason being it presents quite a problem for research analysts who never know which report to look at first. All four companies reported results that were ahead of expectations in terms of revenue. However, Apple shares were down in aftermarket trading, the reason being that the company experienced quite disappointing sales in China. Amazon shares were also down slightly, the reason being that the company has spent quite heavily on expanding its facilities to help it cope with the high level of demand that it's currently facing. One key takeaway, though, for all four companies was the increase in revenue from online advertising. All four of these companies are exposed to online advertising, but particularly Alphabet and Facebook. Alphabet shares were up 9% in aftermarket trading because the company had experienced such a rebound in advertising for both its online search business and also for YouTube, which the company owns. Spending on internet advertising has grown steadily over the last few years, and it has also steadily been taking market share from TV advertising. Let's take a look at some forecasts showing us the forecast total US advertising spend on both internet and TV. So in the green we've got internet spend and in the pink we've got TV spend. So as you can see for this year, both types of spend are expected to fall. However, despite that, internet spend for this year is expected to be twice that of total TV spend. For next year, internet spend is expected to experience a rebound, whereas TV spend is expected to continue flatlining. If these forecasts are correct, then the future looks bright for online advertisers such as Alphabet and Facebook. Despite the good results for the technology sector, the broader market has been rather weak this week as the global level of coronavirus cases continue to rise. It has always been feared that the second wave or the extension of the first wave will happen in October because that's when the traditional flu season tends to start. In the UK and across Europe, we're facing further lockdowns, and that's bad news for the economy, particularly the hospitality and the travel sectors. We've also got ongoing jitters about the US election, which is now next week, and Walmart, which is one of the highest sellers of guns in the US, has announced that it has been taking guns off the shelves because of fears of violence around the result of the US election. Let's take a look at the performance of the S&P 500 and the FTSE 100 over the last 5 years. This chart is indexed, so it shows the percentage return in each of these indices over the last 5 years. So you can see that both have come down a bit over the last week, but despite that, the S&P 500 has still had a very strong year, whereas the FTSE 100 is looking rather dismal. And this coincides with the IMF's latest review of the UK economy, in which it downgraded its growth forecast for the UK. However, it did say that it thinks the UK government is doing the right thing in spending to boost the economy, and it believes that spending on infrastructure will help to boost growth and that spending on helping people to retrain will help to lower unemployment over the longer term. Despite the weakness in global markets this week, we have had some very encouraging bits of data. First of all, over in the US, the latest GDP numbers have been published, and they showed a 33.1% growth in GDP for the third quarter. Here's the chart showing the data over a longer time period, and you can see that there was a significant fall in the second quarter, followed by a very healthy rebound for the quarter just gone. So that's one encouraging sign. And then here in the UK, we've had news that the level of mortgage approvals has hit its highest level since 2007, no doubt helped by the current stamp duty holiday. Both of these bits of data do show that there's still a good level of demand in the economy, and that certainly is a very healthy sign. Moving on to have a look at the diary for next week. On Monday, we've got results out from PayPal and from Estee Lauder. That's it from us. Have a great weekend, and we'll see you next Friday.